investment strategy, firm U.S. jobs report, CCP's 100th year, and the Delta variant. The much-anticipated U.S. non-farm payrolls report did not disappoint, indicating that 850,000 jobs were added to the U.S. market in June, the highest since August 2020. An analysis of U.S. market labor history shows that the decline in the unemployment rate after recessions tends to take some time to reach pre-recession levels, as there is a limit on the pace at which workers can be drawn back into employment. With this in mind, we expect the U.S. Federal Reserve to wait until December before announcing a gradual exit from quantitative easing over 2022, and see this overall dovish stance remaining supportive of risk assets throughout 2021. 1st July marked the celebration of the Chinese Communist Party centenary. In his televised speech, President Xi Jinping touched on the message of self-reliance, strengthening national security, deepening reforms, promoting high-quality development, and building up China's strength in science and technology. Chinese policymakers continue to normalize monetary policy, which has unsurprisingly triggered a phase of consolidation in Chinese equities, and this has been exacerbated by a series of regulatory actions in the technology space as policymakers seek to rein in Chinese tech giants. Over the long term, we remain broadly positive on Chinese markets, given the world's second-largest economy's solid economic momentum. The low rates of vaccination in developing countries continue to be a source of major concern amidst the spread of the COVID-19 Delta variant, and points to the urgency needed to support lower-income countries in order to get the pandemic under control globally. Given that 1. The vaccination rollout continues at a consistent pace in major developed markets, 2. That policymakers are much more prepared at this stage of the pandemic, and 3. That there is very limited political will to reimpose mobility restrictions in a significant manner, our base case is that the Delta variant is unlikely to derail global risk assets significantly. Bottom line, within our asset allocation strategy, we maintain an overall overweight position in equities with a preference for U.S. equities. In fixed income, we remain overweight in emerging market high-yield bonds. We stay underweight in both developed market and emerging market investment-grade bonds, where historically rich valuations leave little buffer against rising rates.